Welcome to this complete balance sheet masterclass for small business owners. In this tutorial, we are not just going to learn what a balance sheet is. We are going to understand how to read it, analyze it, and use it to make smarter business decisions using a practical example inside our balance sheet builder. Let's imagine a fictional company called Bright Horizon Manufacturing LLC. This company produces commercial office furniture for businesses across the United States. Now let us begin with the left side of the balance sheet, which represents the company's assets. Assets are everything the business owns or controls that provide future economic value. The first section is current assets. These are assets expected to be converted into cash or used within 1 year during normal business operations. The first account is cash and cash equivalents. In our example, Bright Horizon Manufacturing currently has $45,000 in available cash. This represents the money sitting in business checking accounts, savings accounts, and highly liquid short-term investments. Cash is the most flexible asset because it can immediately be used to pay employees, suppliers, rent, taxes, utilities, and other daily operating expenses. The next account is bank balance, which shows $125,000. This represents additional business funds available across multiple business bank accounts. Some companies separate operating accounts, payroll accounts, and reserve accounts, making it easier to manage different business activities. Next comes accounts receivable, showing $85,000. This amount represents invoices that customers have not yet paid. Although the money is expected to arrive, it is still dependent on customer payments. Moving further down, we reach inventory, with a balance of $110,000. Inventory includes finished products ready for sale, raw materials waiting for production, and work currently in progress. The next account is prepaid expenses, showing $12,000. These are payments the company has already made for services it will receive in the future. Examples include prepaid insurance policies, annual software subscriptions, warehouse rent paid in advance, or maintenance contracts. You may also notice several other current asset categories inside the application, including short-term investments, marketable securities, notes receivable, sales tax receivable, and other current assets. Our example company currently has no balances in these accounts, so they remain at zero. After adding all of these values together, the application automatically calculates total current assets, which equals $377,000. Notice that you do not need a calculator. Every figure updates automatically the moment you enter or modify a value. Next, we move into property, plant, and equipment, often called fixed assets. Unlike current assets, these assets are expected to provide value for many years rather than being converted into cash during normal operations. The first fixed asset is land, with a value of $150,000. Many businesses purchase land to build offices, factories, warehouses, or future expansion projects. The next account is buildings, valued at $320,000. This includes the manufacturing facility where products are produced, and administrative offices where employees perform daily business operations. The company also owns machinery worth $180,000. For a manufacturing business, machinery represents one of the most important productive assets because it directly contributes to generating sales. Next comes equipment, totaling $55,000. Equipment may include forklifts, production tools, packaging systems, inspection devices, and warehouse equipment that support manufacturing activities. The balance sheet also includes vehicles valued at $70,000. Delivery trucks, service vans, and company vehicles all belong in this category because they help transport products, employees, and business materials. The company owns computers totaling $18,000. These include accounting workstations, office computers, engineering systems, laptops, networking equipment, and other technology used throughout the business. However, fixed assets are not reported only at their purchase price. Most fixed assets gradually lose value as they are used over time. This reduction is called depreciation. Our example includes less accumulated depreciation, showing $93,000. Notice how the application automatically subtracts accumulated depreciation instead of adding it. This demonstrates one of the most useful features built into the balance sheet builder. When all of these fixed asset accounts are combined, the application calculates total property, plant, and equipment as $700,000. Without automation, preparing these calculations manually would require significantly more time and increase the risk of errors. At this stage, we have completed the first major portion of the balance sheet. We have already identified the company's liquid resources, long-term productive assets, and the overall investment made in physical business operations. Let us continue with the remaining asset categories. Although these sections are often smaller than cash, inventory, or machinery, they can still represent significant business value and should never be ignored when preparing a professional balance sheet. The next section inside our balance sheet builder is intangible assets. Unlike land, buildings, or machinery, intangible assets cannot be physically touched. However, they often provide tremendous long-term value to a business. These assets include goodwill, patents, trademarks, copyrights, software, licenses, customer relationships, and brand value. In our example, Bright Horizon Manufacturing owns software valued at $25,000. This could represent accounting software, inventory management systems, production planning software, customer relationship management platforms, or engineering applications that help employees perform their daily work more efficiently. The company also owns trademarks worth $10,000. A trademark protects the company's brand identity and helps customers recognize its products in the marketplace. The remaining intangible asset categories currently have zero balances because this example company does not own patents, copyrights, customer lists, licenses, or accumulated amortization. When these values are added together, the application automatically calculates total intangible assets as $35,000. Next comes other long-term assets. These are assets that do not fit into current assets or fixed assets, but still provide long-term value. Our example company owns long-term investments worth $40,000. This could represent investments in another company, long-term certificates of deposit, or strategic investments expected to generate future returns. Other available categories such as deferred tax assets, long-term deposits, pension assets, and other long-term assets currently remain at zero. The application now automatically calculates total other long-term assets as $40,000. At this point, the software combines current assets, property, plant and equipment, intangible assets, and other long-term assets. The final total assets become $1,152,000. Now let us move to the right side of the balance sheet, beginning with current liabilities. Liabilities represent obligations that the business must pay in the future. Think of liabilities as claims other people have against the company's assets. The first account is accounts payable, showing $72,000. This represents money owed to suppliers for inventory, raw materials, or business services already received. Next is short-term loans, totaling $40,000. These loans usually mature within 1 year and often help businesses manage temporary cash flow shortages or seasonal inventory purchases. The application also shows accrued expenses of $26,000. These are expenses the business has already incurred but has not yet paid. Examples include utility bills, consulting fees, payroll expenses, and other operating costs that will be paid later. Next comes salaries payable, totaling $18,000. Employees have already earned these wages, but payday has not yet arrived. Since the company owes this money, it must appear as a liability. The company also reports income taxes payable of $24,000. This amount represents taxes already owed to government authorities but not yet paid. Finally, we see unearned revenue or customer advances, totaling $15,000. This represents money customers have already paid before the company delivers products or services. Several other current liability categories remain at zero because they are not being used in this demonstration. Examples include bills payable, bank overdraft, interest payable, sales tax payable, dividends payable, and other current liabilities. After combining all current liabilities, the application calculates total current liabilities as $195,000. The next section is long-term liabilities. These obligations extend beyond 1 year and usually finance long-term business growth. Our company currently has a long-term bank loan of $250,000. This loan may have been used to purchase machinery, expand production facilities, or finance business expansion. The company also carries a mortgage loan totaling $170,000 for its manufacturing facility. Another liability is the long-term lease liability, valued at $50,000. This represents lease obligations for long-term business assets. Deferred tax liabilities, pension liabilities, bonds payable, and other long-term liabilities currently remain at zero because they are not applicable to this example. When all long-term liabilities are combined, the application automatically calculates total long-term liabilities as $470,000. Adding current liabilities and long-term liabilities together produces total liabilities of $665,000. Now we arrive at the final section of the balance sheet, which is owner's equity. The first equity account is owner's capital, totaling $250,000. This represents the money originally invested by the business owner into the company. Next is retained earnings, valued at $151,000. Retained earnings represent accumulated profits from previous years that remained inside the business instead of being distributed to the owner. The final account is current year profit, totaling $86,000. This represents profit generated during the current accounting year that has not yet been transferred into retained earnings. Other equity categories such as common stock, preferred stock, additional paid-in capital, treasury stock, and owner's drawings remain available inside the application for corporations and other business structures that require them. When these values are combined, the application automatically calculates total equity as $487,000. Now comes the most important moment in the entire balance sheet. The application automatically adds total liabilities and total equity together. The result equals $1,152,000. That number exactly matches total assets. Because both sides are equal, the accounting equation displays balanced. This single result confirms that the financial statement has been prepared correctly. If both sides did not match, the application would immediately notify you that something is wrong, allowing you to locate errors before sharing financial reports with investors, lenders, accountants, or business partners. Working capital measures the money available to operate the business after paying short-term obligations. The application calculates this automatically by subtracting current liabilities from current assets. In our example, company has current assets of $377,000 and current liabilities of $195,000. After performing the calculation automatically, the application displays a working capital of $182,000. This is an encouraging result because it tells us the company has enough short-term resources to meet its upcoming obligations. Positive working capital generally indicates better liquidity and greater financial flexibility. The next financial measure shown by the application is the current ratio. This ratio compares current assets with current liabilities. Instead of looking only at cash in the bank, it evaluates whether the business has enough short-term assets to cover short-term obligations. The application also calculates the debt-to-equity ratio. This ratio compares the company's borrowed money with the owner's investment. It helps business owners understand how much of the business is financed through debt versus owner capital. Another useful measurement is the debt ratio. Instead of comparing debt with equity, this ratio compares total liabilities with total assets. It answers a simple question: what percentage of the company's assets is financed by borrowed money? The lower this percentage, the more financial independence the business generally has. A higher percentage means creditors have a larger financial claim on the company's assets. The next calculation is the equity ratio. This ratio shows how much of the company's assets are financed by the owner's investment instead of borrowed funds. A stronger equity position often improves financial stability because the business depends less on external financing. This can save a tremendous amount of time, especially when entering large numbers of accounts. Now let us move into the graphs and ratios section. The first chart compares assets, liabilities, and equity. At a glance, you can immediately see that total assets are larger than either liabilities or equity individually, while liabilities and equity together equal total assets exactly. This provides a visual confirmation of the accounting equation. The next chart displays the asset mix. Instead of showing one total asset number, it separates assets into current assets, property, plant, and equipment, intangible assets, and other long-term assets. The application then displays the liability mix. This chart compares current liabilities with long-term liabilities. Immediately, we can see that most of the company's obligations are long-term rather than short-term. One of the biggest advantages of this application is its settings and customize section. Every business is different. Rather than forcing everyone to use identical categories, this application allows complete customization. You can add new asset accounts whenever needed. You can remove categories that are not relevant to your business. If your accountant recommends adding a new account next year, you can create it in seconds without changing the structure of the application. Another useful feature is the currency symbol setting. Instead of rebuilding the application for every country, simply type your preferred currency symbol inside the Settings and Customize tab. Finally, once your balance sheet is complete, the application generates a professional print layout. The report is designed to produce clean, organized financial statements that can be shared with business partners, accountants, lenders, investors, or management teams. Get your copy of the Balance Sheet Builder and start creating professional balance sheets today using the link below. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.